I'll request CA Vivek Nevitia ji to kindly join us on the stage. I'll also request CA Rashmi Chaucharia to kindly come on the stage. I'll formally introduce CA Vivek Nevitia ji, who will be speaking on the topic tax and FEMA implications for emigrating and immigrating individuals. CA Vivek Nevitia is a practicing fellow chartered accountant and a registered valuer, certified FAFD and a management graduate from University of London. With over 17 years of professional experience in handling assignments relating to diverse services in areas of enterprise valuation, statutory, forensic and investigative audits, corporate finance, business restructuring, turnaround strategy, mergers and acquisitions, takeovers, spin-offs, negotiations of joint venture, business advisory services, regulatory issues, etc. He is currently serving as a special invitee in the Accounting Standard Board and a member of Ind AS, IFRS, and in various advisory groups. He has served as a co-opted member of the Expert Advisory Committee of ICI, Committee of International Tax ICI, Research Committee ICI, and Corporate and Allied Laws Committee EIRC of ICI. With this, I welcome CA Vivek Nevitia ji. I request CA Krishna Tibrewal ji to kindly come forward and present an Uttario and a memento to CA Vivek Nevitia ji. Without further ado, I request CA Vivek Nevitia ji to kindly take the session forward.
I'm good. Thank you. A very good afternoon, everyone. Thank you, ACA, for inviting me. It's coming to your own association. It's always wonderful to speak at your own association. And speaking to Mr. Kapasi was just too good. I think he could have continued for the next 1 hour also. I could have been a speaker at probably one of the other events, but I think his session on income tax structuring was one of the best sessions I've ever attended in the recent past probably, and the kind of ideas and suggestions that he gave was just too good. Coming to this topic on interplay of FEMA and income tax, I think most of us today practice income tax. I think there is less of awareness of how FEMA works, foreign exchange laws work, and especially when there is a amalgam or an interplay of both these laws, there is a gap which is seen when we come to advising our clients on how both these acts interplay. When we look at Foreign Exchange Management Act and income tax together, if we look at how families are operating today, and a typical high net worth individual would probably have these cycles, so as to say that they would probably be a resident today, they would probably expand their presence abroad by making some overseas investments. Then one of the family members or the sons, when they grow up, would probably go outside and migrate to an overseas country. Then that person would become a non-resident, and there would be a requirement of movement of funds from India to abroad. Now, this person, when he becomes a non-resident and migrates outside India, would now be required to make some inbound investment into India, because the India story is shining and is ever shining, so as to say, with the new government coming in from 2014 onwards. I think there has been a significant expansion in terms of the foreign investment coming into India. Then suddenly I realized that I have to return back to India. And therefore, there's again an implication of how I would be taxed, or how would FEMA operate when I return back to India, and therefore I again become a resident. So this cycle which is there, if you look at each cycle, whether I'm making an outbound investment, whether I'm migrating outside India, when I'm becoming a non-resident, when I'm making an inbound investment, when I'm returning back to India, in each of these segments, there is an interplay of FEMA and income tax. And this is where our role as advisors become very, very significant. And we have to understand each and every segment separately. We cannot ignore foreign exchange laws when we are advising on income tax, and vice versa. So what we'll do is, basically we'll look at each segment. I will probably not touch upon the succession part, but I would probably touch upon the first 4 or 5 segments of the sections, which would include how I would structure an overseas investment, Overseas investment rules have been recently revised way back in 2022, and there has been significant relaxations as well as restrictions which have come up. So we should be aware of how overseas investment regulations work now. Residence works differently when it comes to income tax, when it comes to Companies Act. So when it comes to income tax, when it comes to foreign exchange laws. So we have to be very careful with how residence works, especially with respect to place of effective management, and how do we mitigate the risks associated with place of effective management. Another question which is often asked is, how do we repatriate the funds which are lying abroad? That is again something which has to be looked at from a foreign exchange angle, because there are specific foreign exchange laws on how repatriation of assets are allowed and how income tax works on those repatriations. Funding, of course, we have to fund either the overseas entity which we are creating, or we have to fund the Indian entity which is there. And when there is a family wherein we have businesses not only in India, we have businesses abroad, there could be scenarios where the foreign entity is flushed with funds, and those funds have to be brought back to India in a tax efficient manner. And we have to ensure compliance with income tax as well as FEMA. And sometimes it's the reverse, where the Indian company would make a remittance abroad for making an investment. So we need to ensure that both these aspects are taken care of whenever we advise on families migrating abroad or families coming back to India. Disinvestment is another section which we talk about when it comes to exit of foreign entities. This is often missed when we plan a structure, when we structure a company, when we create vehicles abroad for businesses. Let's say we are creating a Singapore structure, intermediary structure. Someone advises us, UAE is a better structure. We again create an intermediary structure in UAE. We have two intermediary structures. We have structures in, let's say, investments through UAE and Singapore and various other countries, such as maybe Vietnam, such as Africa, maybe US, maybe Europe. But we seldom forget that when we have two intermediary structures, we create multiple exposure risks from an income tax and FEMA perspective. We should decide from day one what should be our structure is, how the business is planned by the family in the next 5 to 10 years. It's just not about the next 1 year where the tax is beneficial. You should plan your affairs, the family should plan its affairs for just not 1 year, but for the next 5 to 10 years on how the structure should be. And that structure should be relatively mid-term sustainable. If that structure is not mid-term sustainable, there would be challenges which you would face at some point or the other when you need funds for further expansion. I'll not get into succession, but just to give things in perspective, there is significant estate duty inheritance tax which is now applicable across other jurisdictions, not in India, but India there is a lot of talks. There are a lot of talks which are going around about estate duty coming up, setting up trust structures, setting up structures to ensure that the family is taken care of in future. Possibly if there's a dispute between the brothers, how would that structure be taken care of? Keeping estate duty aside, trust structure is probably coming up very well, considering the interests of the family becoming larger, considering the needs of the family, and many companies becoming exposed to the market, becoming listed, and therefore there is a trust structure which is coming up very well. But even otherwise, when you are setting up structures, for example, in US, Europe, where there are significant inheritance tax, estate duty tax, we need to be very mindful of that. For example, if you are having ownership of, let's say, a share in Google or Microsoft, if you die, there is an estate duty tax on the shares, fair value of the shares of the Google or Microsoft. So this is something which you have to be very mindful of when you are structuring transactions, in countries, particularly where there are estate duty tax and inheritance tax. Coming to just a background of FEMA, when you look at foreign exchange laws, one thing which you should be very mindful of is what cannot be done directly cannot be done indirectly. So it's not a very legal, interpretative based law. You have to look at more of the intent behind why the law was written, and interpretations keep changing. For example, when liberalized remittance scheme was originally introduced way back in 2004, I believe, overseas investment in overseas entity was permitted without any compliance with respect to filling up ODI form or filling up form FC. Suddenly in 2013 or 14, RBI came up with a circular which said that no, that was never the interpretation. I cannot be allowed to make a direct investment abroad. I'm required to comply with ODI forms, ODI guidelines, and only then I can make an investment. Since 2014, the position has changed, and there have been a number of restrictions which have been put up under LRS regime. So we have to be very mindful of how the laws are changing over time, and sometimes the application of FEMA laws depends on the specific individual who is monitoring your case or who is handling your case. So even there is a difference in interpretation of how authorized dealers are dealing with a particular overseas investment. For example, if most of you may be aware of certain safe transactions, transactions which get converted into equity at a later stage. These instruments are quite common in US. Now, if you look at authorized dealers, there are certain authorized dealers which are not very comfortable with safe transactions, with safe equity. They are more comfortable with transactions which are pure equity in nature, and they would prefer that investment is made only indirectly in equity, not in instruments which can possibly convert into equity, and therefore there could be a potential risk with respect to the investment abroad. RBI does not make it stand very clear. RBI sometimes experiments with what the investments are being made, with what kind of money is going abroad, and then it decides on bringing out with a circular clarifying its position, merely clarifying, and that creates a lot of challenge with respect to the transactions which we have already undertaken. So therefore, we need to be very careful and be slightly conservative when we are advising on FEMA law. So if you are conservative when you are advising, I think this will help in the longer run for the client, and also ensure that your advice is accepted by the regulator at a later stage. So please always ensure that whenever you advise on foreign exchange laws, just not advise that since this is not specifically written, this is permitted. In foreign exchange laws, if something is not written, it is prohibited. Be clear about that. For example, there are various structures which go on with respect to trusts which are created for the benefit of non-residents. Those create challenges. So we have to be very careful when we create structures for succession with respect to trusts where non-residents are beneficiaries. So always be on the conservative side. Trust is not recognized as a person by the FEMA law. Trust is considered just as an extension of the individual from a foreign exchange perspective. So be very careful from interpreting and advising on foreign exchange laws. Also, one thing I think most of us are now aware, that residential status under FEMA is not the same as residential status under income tax. This is something which is I thought this presentation would be slightly going ahead with an assumption that we would have some knowledge on FEMA and income tax. I would not go into the very basics because then it would not be a structuring session. So I'm slightly going ahead with the assumption that most of us are aware that residential status under foreign exchange laws are different from the definition which is given under the income tax. So please be mindful of that when you are advising on residential status under FEMA. Especially when you look at people who are going abroad for employment, people who are coming into India for employment, the income tax and FEMA just works very differently. How you disclose your foreign assets in your ITR, how you disclose to your authorized dealer your residential status, it's something which is very, very different, and we need to be very careful and document each and every step when we are advising on people who are going abroad or coming into India. We should have a checklist in place internally so that we are able to ensure that nothing is missed. Each and every step, because when we are communicating to the authorized dealer, when we are filling up a form, account opening form with a bank, it is the FEMA residential status that is being asked for, not the income tax residential status. So be very mindful of that, and basis that only you proceed with the advisory that you give with respect to foreign exchange. Coming to outbound structuring with respect to ODI, I would spend some time on overseas direct investment, and then I would spend some time on individuals migrating from India, and I would spend the least amount of time in individuals returning to India. So this is how I've structured my presentation. With respect to outbound structuring, all of us are aware the routes for ODI which is there. I can, from an Indian company or an LLP or a registered partnership firm or a body corporate can make overseas direct investment. There are various modes which are given. subscription to MOA, purchase of equity capital, bidding or tender procedure, capitalization of dues which are receivable from the overseas entity, swap of securities, swap of shares again is a very new, very common nowadays with many people who had earlier shifted abroad, now want to come back to India and want to settle, get their base back to India. Certain entities which were earlier created where there was a Singapore holding structure, they moved out, they became non-residents, and then they had their Indian subsidiaries created as startups in India. But now they want to come back to India because they feel that the India story is much better than the other foreign jurisdictions. And therefore, there is a swap of securities, which is very common nowadays. And swap of securities has been allowed under the automatic route, wherein you are directly investing in shares of the Indian company by selling the shares of your foreign company. So there's a swap which is happening. You can also acquire shares through merger, demerger, schemes of arrangement, or under applicable laws. A resident individual, I'm putting that resident individual separately because there are specific restrictions which are there when a resident individual makes an investment. This is where most of us make a mistake. If there is a resident individual making an investment in a foreign entity, I cannot have a step-down subsidiary or a joint venture. Let's say an Indian entity having an investment of 90% in a foreign company, let's say in Singapore, another 10% is held by a resident individual just for the sake of comfort and security. If I'm having this 10% stake in that foreign entity is not allowed to set up any subsidiary JV abroad. I cannot have a single investment in that that entity which is set up in a foreign jurisdiction. Now, most of us would say that how come Indian laws govern that foreign jurisdiction company? That is not the case. The advisor in the foreign jurisdiction will probably advise you that you can make any investment from that Singapore company, but Indian FEMA laws would apply to that foreign company, would apply, and therefore as a resident individual, if you are invested in Singapore company, that Singapore company will not be permitted to invest in any other company. So we need to be very careful with respect to how a resident individual makes an investment in a foreign jurisdiction. Also, resident individual can only invest in equity capital. I cannot give a loan to the company in foreign jurisdiction. So if as a resident individual, if I want to invest in equity as well as loan, I'm not allowed. I can only invest in equity of the foreign jurisdiction. So that is also a condition which is there. Of course, I can invest through capitalization of my dues which are receivable from me in respect of professional fees, maybe in respect of consultancy which are there. Swap of securities by way of merger, demerger, amalgamation, liquidation is permitted. Gift is permitted. Gift, there are certain compliances which are required to be made. Earlier, what used to happen is I would ask a friend to incorporate a company abroad before the 2022 regulations. That friend would gift me a share of the foreign company jurisdiction to me. Let's say he forms a company of USD1 in Singapore. That USD1 share was gifted by my friend to me. And technically, there was no requirement of filing Form FC or Form ODI for the purpose of that company shares of the company which was acquired by me, of that foreign company. But now, as per the ODI regulations of 2022, I am now required to file a Form FC even for that gift which I am receiving. So if I am receiving a gift of share of a foreign company which may be as nominal as USD1, I am required to file Form FC because I am now having a direct investment in that ODI, and therefore I am required to file Form FC. I can acquire shares by way of sweat equity shares, ESOP, employee stock benefit scheme, which are covered in the OAI regulations. I would not be covering that in detail. So basically, the ODI, the way it looks like, it's quite a liberal framework under the automatic route, allowed up to 400% of net worth, almost allowed in all sectors except real estate, gambling, and dealing in products linked to INR, and activities not permitted in India. So these are the 4 prohibited sectors which are there. Any number of subsidiaries allowed other than by resident individuals. So I can incorporate any number of subsidiaries by that entity which is, let us say, set up in Singapore. Loans and guarantees allowed subject to reasonable restrictions. So basically, it's a liberal framework if you look at the allowabilities which are there. Real estate development is permitted. Real estate trading is not allowed. So if I am making an ODI in a company which is engaged in construction or development of a property and leasing it out, that would be permitted. But if I am engaging in purchasing a property and selling it, that would mean trading in property and therefore would not be allowed. So we need to be very careful of how the real estate transaction, if at all it is invested abroad, how that real estate transaction is structured. So you cannot have a scenario where you invest in a completed property, put it on rent, and sell it later. So there could be a potential risk of foreign exchange laws being violated and real estate trading getting kicked in. So also you need to be mindful of investment in financial services sector. As a resident individual, I am not allowed to invest in any entity which is engaged in financial services. However, if I am a company, I can invest in a company which is engaged in financial services. This was earlier not allowed. You can only invest in a financial services activity company if you are yourself a financial services company. Since 2022, even if I am a company which is not engaged in financial services, and if I have a track record of profits for the last 3 years, I can invest in a company abroad which is engaged in financial services. The only restriction is I should not be a resident individual. As an Indian company, I can invest in a foreign company which is engaged in financial services activity. This is now permitted provided there are certain conditions which are required to be met. If you meet those conditions, most of the Indian company can invest in a foreign company which is engaged in financial services. A resident individual cannot. So if the resident individual even has one share in the foreign company, that foreign company cannot engage in financial services activity. So the Indian company would have to, the shares of that foreign company has to be owned entirely by either an LLP or an Indian company or a registered partnership, but it cannot be by a resident individual. Round tripping is now allowed up to 2 layers of foreign investment. This was earlier not allowed. This was not specifically prohibited. This was not specifically permitted prior to 2022. This was looked at RBI not favorably, and wherever the round tripping investments were there, that was not looked at favorably, and RBI would question the Indian entity wherever there was a round tripping. Now, what would round tripping mean in this case? Let's say Indian company 1, it invests in Singapore company 2, Singapore company. That Singapore company again invests in another Singapore company. Now that Singapore company can invest back into India because there are 2 layers of foreign investment. Now there cannot be another third layer of foreign company in between. So till 2 layers I am allowed to have a round tripping structure, and that is how, if you look at the gift city structures which are coming up, is because of this round tripping which is permitted. So for example, an Indian company investing into Singapore company may possibly invest into gift city, and that would be allowed. So, and that gift city again can actually invest back into India, because gift city, although a foreign jurisdiction, there are no more than 2 layers of foreign investment. So you have to look at 2 layers from a foreign investment perspective, you do not count it from India. So A, B, C, D, where B and C are companies in foreign jurisdiction, A and D are in India. So this would be permitted. You cannot have A, B, C, D and E, where B, C and D are foreign jurisdiction companies, and that would not be permitted. So it says you cannot have more than 2 layers of intermediary foreign investment, and this ODI regulation 19 makes it very clear as to the kind of round tripping which is now allowed. ODI versus OPI, again this distinction has to be very clear with respect to unlisted entities abroad. Most of the families invest in unlisted entities abroad. Even a single share in an unlisted company abroad makes it ODI. So there's always some confusion that if I'm holding less than 10%, it should be OPI, but that is not the case. It is with respect to listed companies, wherein if I'm holding less than 10%, it will be OPI. But with respect to an unlisted entity abroad, even if I'm holding a single share, I would have to comply with the ODI guidelines. Most of the companies, family, big businesses, big industries today invest in startups abroad. Let's say there is a startup which is set up in Singapore or in Australia with respect to green energy, with respect to any tech-based, fintech-based startup. And what happens is those companies are technically unlisted, and even if as a resident individual, if I'm investing even a single share, or even an Indian company investing in a single share, I would have to comply with all the Form FC guidelines, all the Form ODI which was there previously. I would have to obtain the valuation report, I have to approach the authorized dealer, I have to ensure that the valuation guidelines are met, I have to ensure that those instruments which I'm investing in is compulsorily convertible into equity. Only then I can invest. If I'm not looking at those aspects, if I'm just making an investment without complying with the guidelines, there's going to be a problem later. I dealt with a particular case where a resident individual had made investment into a Singapore-based company which was engaged in solar energy. Now they did not file Form FC. After 3-4 years, when they were raising funds further for the purpose of further expansion, at that time they approached an Indian company for further investment into that Singapore-based company. Now, when they were resident individuals, they continued with the investment they made, with their own funds, and there was never a question asked by the authorized dealer, because the authorized dealer probably was not aware of the foreign exchange guidelines. Now, when this company was making the investment, at that time the entire problems arose, and then they had to approach the RBI for compounding, and it almost took a year before it could be regularized. So you need to be very careful with respect to how you structure a transaction, how you ensure that the compliances are made good before the investment is further made. Any questions on ODI? We'll just move to exposure to POM with respect to.
Cannot give loan. Is it possible that I as an individual have a EEFC account and I give loan through my EEFC account?
I'll have to just check I think that could be possible because it's an EEFC account. I think it can be possible, but okay. I'll have to check.
Just one more. You said that as an individual, I cannot invest in a foreign company which has a step-down subsidiary or a JV. Now, post-investing, since it is not in my control and I'm a minority shareholder, if they have a steps-down subsidiary...
It's not permitted. It's strictly not allowed.
But that company or its jurisdiction is not under my control. So will it trigger...
Irrespective. You are not complying with the foreign exchange guidelines.
So then what is my...
You have to divest.
Divest. Okay.
That's the only option. That's the only option.
But still penal provisions are attracted because...
You may be asked to compound. You may be asked to compound.
Okay. Take. Fair enough.
Yes.
You were saying that as an individual...
There's a specific exemption to gift city. Cities.
I'm not route tripping. I'm just prior to that, there are restrictions on investing in financial services companies.
Right.
What about AIFs set up in Dubai or REIT set up in Dubai, Australia, Singapore?
No, so there's a difference between ODI and OPI. So you have to look at the OPI guidelines in that case.
But they still, most of them are still unlisted.
So AIF, if it is the way it is structured, the way the transaction is structured, if the AIF is not listed and it falls under the ODI guidelines, if it falls under debt instruments, there's a difference. If it's a non-debt instrument, then you have to look at ODI guidelines. If you look at Schedule 5, I think, which talks about resident individual investing in certain specific this AIF, if it's an indirect share in the equity unlisted, I think it may not be allowed. You have to route it through an Indian company, that investment.
Okay, thank you.
But I still have to look at the relevant provisions once again before confirming.
Good afternoon, sir. Sir, as you said, resident individual, say for example, a resident individual made an investment in a Singapore entity, and now that Singapore entity can make investment in any other third entity without acquiring control?
No, I don't think that is permitted. Because without acquiring control is only permitted in specific circumstances, which would include merger, or there would be certain specific exemptions which are allowed for 3 or 4 cases, such as gift, etc. In which case you are allowed to have an investment less than 10% without control. There are certain exemptions which are given, which we'll have to just deal with. I can probably share with you offline. There are certain exemptions which are there, but if you are having any investment in an unlisted entity, even a single share, technically you are required to comply with the ODI guidelines. And if you are making investment through banking channels abroad, that would trigger ODI guidelines and create challenges.
Okay, sir. Thank you.
As an individual, when I'm investing, so LRS is applicable on me.
Yes.
So is there any specific approval which we can take if we want to invest an amount higher than that?
You can, but what we have seen practically is RBI does not allow.
Does not allow.
Does not allow.
So then we have to go by an Indian entity only.
Yes.
And in case of an Indian entity, there is a requirement that maximum you can remit is up to 400% of your net worth.
Right.
This net worth calculation has to be on a specific date, or is it?
It generally speaks about latest audited balance sheet. So you can always have an audited balance sheet done.
No.
Full complete audit, and basis the latest audited balance sheet which is available for that specific purpose, you can invest up to 400% of net worth.
Thank you.
Good afternoon, sir. So if the investment is not made through any banking channel, like in case of ESOPs of like well-to-do companies, they get shares on Luxembourg Stock Exchange. So in that case, no additional compliance is required?
No compliances are required.
Irrespective of the amount?
नहीं ऐसा नहीं है, मतलब कितना percentage है, and that उसमें there are specific conditions which are prescribed, which is with respect to if that ESOP scheme is available for all the employees. It's not. It cannot be for a specific employee.
Yeah, no, it is available for the employees, but what happens is like a senior person from an IT company. So he has shares worth say 10 crores in the form of ESOPs.
No, sir, but these are very fact specific, and we have to look back to the laws to answer this question. So if you look at Schedule 5, I probably would have to look at those laws to answer the question. These are very fact specific questions.
Okay. Thank you.
But I can answer back post the session. I'll just look at the relevant provisions and come back to you. With respect to ODI's overseas direct investment and exposure to place of effective management, company is resident of India if the place of effective management is in India. Section 6(3) of the Income Tax Act makes it very clear that I would, as a foreign company would be treated as a company resident in India if the effective management of that company is in India. So what is this effective management? It's a place where key management commercial decisions that are necessary for the conduct of the business of the entity as a whole are in substance taken. So basically it talks about substance over form and on how the effective management of the company is being undertaken. There could be different places of management, but there can only be one place of effective management. So that place of effective management, the way it is identified, there is a board circular to that effect on how the place of effective management can be looked at. So we need to be very careful of how to ensure that if we are setting up a company abroad, for example, most of the entities in India, what they do is the directors are Indian, the investment is from India, all the decisions are taken from India, the accounting records are kept in India for a company in Singapore or in UAE, and therefore there is a big risk or a high risk of that company becoming an Indian resident and be taxed at a maximum marginal rate of 40%, which has been reduced in the current Finance Act. So we need to be very mindful of how we are able to mitigate the risk of place of effective management. And this place of effective management is not a one-time exercise, but has to be determined on a year-on-year basis. And every year you need to ensure that those checks and balances are kept within the foreign company to ensure that the place of effective management is actually outside India. Now, place of effective management, as per the circular which is issued by the CBDT, it says that it is presumed to be outside India if the company is engaged in active business outside India, the ABOI test, which is there. So ABOI test basically talks about if more than 50% of the revenue is coming from active income, more than 50% of the purchases are from active or from trading. For even trading is considered as an active business, for example. 50% of your employees, more than 50% of your employees are outside India, more than 50% of the salary bill that you are paying to the employees are outside India. So those are the conditions which are required to be satisfied to ensure that the company is engaged in an active business outside India. If all those 4 cumulative conditions are met, I would be considered as a company engaged in active business outside India. So if I'm meeting the condition of having an active business outside India, it's just not sufficient. I have to ensure that the board meetings are also held outside India. So the majority of the board meetings should be held outside India, and there should be an active business outside India to ensure that the place of effective management is outside India. So you have to be very, very careful of how you actually establish that there is an active business outside India. Just showing trading activity in a foreign company may run you to a risk, and therefore you need to be careful of to ensure that actual substance is shown rather than just on paper. And what happens when the ABOI test is not met? So circular also clarifies that if, for example, the company does not meet the test of active business outside India, in which case how you determine the POM is based on subjective parameters which are outlined here. One could be where the location of the board of directors, where they generally meet. If the senior management or advisors who take the decisions, it's where the senior management and the advisors sit. If the powers are delegated to an executive committee, where the members of the executive committee actually sit. Location of the company's head office is where the mind of the company sits. It's not just the registered office of the company, it's where the decisions of the company are actually taken if we are not able to decide basis the earlier 3 bullets. Residence of the majority of the directors or decision takers where modern technology such as VCs, virtual conferences, etc. are used. So we need to also look at where the residence of the directors who are taking decisions on behalf of the companies are. If the above does not give a clear indication of where the place of effective management of that company is, we need to understand where the place of the substantial activity is of that company, where the main economic activity is of the company, or where the company is maintaining its accounting records. So these would be secondary factors for determining the place of effective management of that particular country. Now let us take, for example, an Indian company, a Singapore company, an African company. Now what the Indian company is doing is selling goods to its African company, and it's routing everything to Singapore. All the decisions are taken from India. There are 2 directors, one Singapore resident director and one Indian director. The Indian director is the signatory to the bank account. All the transactions are done online sitting in India. The person has never gone to Singapore. There's a big risk on the substance part. Everything is being exchanged from India. All the transactions are being undertaken from India. The mind and even the physical presence of the directors is in India. Just by showing that the board meeting on paper is being held in Singapore and I am attending probably through a VC and probably the passport even does not justify that, you run a huge risk of place of effective management being in India. So the point that I'm trying to make is opening a company is very, very simple. You can probably sit here, do a phone call to a Singapore-based lawyer and the company would be formed within the next 2 hours. But the bigger challenge is to ensure that the substance is maintained throughout the period when the company is in existence. Now, just one thought process which I also wanted to make was, there could be scenarios where the POM may be in India because of the income tax department identifying place of effective management in India, and there could be other scenarios where even if that company's place of effective management is in India, and if that company is in loss, you are basically not running a risk of, even if that company's effective management is in India, you basically do not have a risk of any tax liability coming up, because even if it is treated as a resident of India, there is no tax liability because the intermediary or the intermediary holding structure is running at a loss. Now, coming back to the circular with respect to how POM operates, Now, even if I have an active business outside India, the circular goes on to say that if the board of directors is standing aside and not exercising the powers of management, and such powers are exercised by the holding person or any person resident of India, the poem will be in India. So even if I have an ABOI outside India, even if I have majority of board meetings outside India, if everything is on paper, there could be a huge risk of POAM being decided in favor of India because of the way the decisions are being undertaken. There could be emails which are the holding company's emails which are being used when a survey happens or a search happens. The person resident in India is taking all the decisions, and there could be a huge risk of that poem being decided in favor of India because of the way the decisions are being undertaken. Now, what is not relevant for determining POM as per the circular? It says that the date, whoever takes the day-to-day routine operational decisions, that is not relevant for deciding where the POM is. It's more of how the strategic decisions, how the decisions of how the business is being conducted is being decided. That is the relevant factor for determining POM. And these isolated facts, such as ownership by an Indian company, the fact that an Indian company is owning a foreign subsidiary does not make it a POM in India. So just because as a shareholder I am exercising a control function or if as per the Companies Act, as per the local Singapore Companies Act or the UAE corporate law, I am exercising functions as a shareholder, that would not make POM in India. Only if I am taking making decisions, if the decision making functions are conducted from India, it is where the risk arises. So even, for example, local management, if it's situated in India, does not make it a POM in India. You have to look at how the decisions are in substance being taken. So basically, we have to look at what is being produced on paper, how many times are the directors moving out to look at decisions, what are the strategic controls are the directors putting in place to ensure that the POM risk is mitigated. Now, one part which is very, very relevant here is, let's say you may decide that the POM is in India from an income tax perspective. That is one risk which you probably can take care of by paying a tax. Another risk which comes up when the POM is in India is from a foreign exchange law perspective and Companies Act perspective. If there is a place of effective management is in India, under the Companies Act, there could be a possibility for registering that foreign company in India and registering with the local ROC. So there could be a potential risk of having a POM in India also under the Companies Act. This is one point which we often miss out on. What Companies Act 2013 states, if a foreign company has a place of business in India, I am required to register myself with under the Indian Companies Act with the Register of Companies. So that becomes a risk when we have a POM in India. So we should not be thinking just about the income tax. We should also think about the Companies Act and foreign exchange laws when we look at a foreign company having exposed to a POM in India. Also, let's say we are able to satisfy the ABOI test, we are able to satisfy the board of directors taking majority of decisions outside India, we are able to say that all the decisions, majority of the decisions are being taken outside India. There's also a risk of business connection. So a risk of business connection or the permanent establishment test also specifies that place of management, if it is in India. If the place of management of that particular foreign company is in India, not place of effective management, place of management is in India, there could be a potential risk of business connection or permanent establishment in India. If, let's say, 100% of your goods are being sold from India to that Singapore entity which is selling onwards to a foreign jurisdiction, there could again be a risk of business connection or a permanent establishment in India because of that particular economic activity being carried out from India. So you could therefore be potentially exposed to the transfer pricing implications, and generally speaking, if the transactions that are at arm's length, that business connection risk could probably be mitigated. So we need to be very mindful of these aspects and just not focus on POM under the Income Tax Act. We should also look at the foreign exchange laws, we should also look at the Companies Act on place of management in India, and we should also mitigate the risk of business connection and or permanent establishment under the relevant treaties. So please look at these aspects also and just not focus on mitigating the POM risk. That is the point I wanted to make here. Now, how could a possible mitigation of exposure under POM can be done? Certain points which I thought would be relevant is delegation of decision-making powers. Please identify someone in the foreign jurisdiction who is responsible for decision-making. Do not have a decision making only up to certain thresholds. Do not have a scenario where, let's say, decisions up to 5 crores of purchases will be taken by the person locally, and the decision beyond 5 crores will be taken by the local Indian person. Do not have that scenario. Have decision making powers which are clearly defined. You as a shareholder can probably step in and you as a shareholder can probably step in and say that, look, I want to have certain strategies in place or have certain controls in place. I could probably be a dual signatory to ensure that my funds are not diverted. I could possibly have 2 bank accounts in the foreign jurisdiction, wherein in the first bank account I would probably credit the proceeds or the investment which I'm making from India, and the second bank account is based on the budgets. The first funds from bank account 1 would be shifted to the bank account 2, and the person who is being delegated to the decision making powers is in control of bank account 2. So that could be one way of ensuring that decision making powers are properly delegated to the person who is residing in that foreign country, who is also probably part of the board or senior management. And please do not have a situation where you're just paying maybe 10,000 rupees or 15,000 rupees to that person situated in the foreign country. You need to have substance in place. You need to have a relatively senior person who is justified in taking such decisions, and he should be senior enough and his remuneration should be justified to ensure that those decisions are being properly made. Wherever decision-making powers are there, try to convert those decision-making powers into an advisory role. You can probably step in as an advisor who is advising on how the business would be conducted, but the ultimate decision-making would rest with the local person or the person who is the board or the committee there, who maybe 2 or 3 persons who are taking decisions with respect to that foreign company's business. The foreign company's business should not be completely dependent on, should not be guided by how Indian company operates. Have a separate domain, have a separate email ID. Those fact patterns help in ensuring that substance is met. You have to detach yourself to a shareholder level control. You have to maintain a supervisory role, and you cannot be part of the daily decision making. You are, as a shareholder, you have made an investing interest, and basically as a shareholder level control, you are exercising the functions with respect to the management. With shareholder level control, you are exercising a control over the company and not on a strategy or a business decision perspective. The fiduciary role between the board and the shareholder should be clearly established. Take decisions abroad. So residence is not important. So it's not necessary that I have to become a non-resident. But try to ensure that decisions, whatever are being taken abroad, not in India. You may also think of creation of a branch outside India rather than a subsidiary or a joint venture or a corporate structure. Possible for some activities. However, the risk when you create a branch, particularly in jurisdictions like US, you create unlimited liability for you. So that is where the risk arises, and therefore you should be mindful of creating a branch if at all you want to create. So if you're only engaged in trading activities, probably in a country like Singapore or Hong Kong, a branch also helps what you intend to do. But if you are creating a more complex structure wherein you have certain other entities downstream, you may have to create a corporate structure for the purpose of ensuring the investment is tax efficient as well as the flow of funds is efficient. Coming to repatriation of profits from foreign company, this is again a discussion point when we discuss with respect to creation of a foreign company. How do we actually repatriate profits from a foreign company? One is, of course, the simplest route possible is dividend repatriation. For example, UAE, there is no tax except if the business is being conducted from UAE directly. If you are set up in free trade zone, there would be no tax. Singapore also does not levy tax on dividend repatriation. There's just a corporate tax rate which is applicable of 16 to 17%, and the balance amount can be 100% distributed as dividend. So in case of dividend repatriation, the 15% benefit which was earlier available has been done away with, and now it is taxed at the maximum marginal rate. Now, if I am taking a foreign credit for the tax which has been paid abroad, or the withholding tax which has been deducted, or the underlying tax credit which is available, for example, in Singapore or in US, if I'm taking that credit, I may not be able to claim the deduction under Section 80M. So it's something, a trade-off, wherein whether you want to take a tax credit, foreign tax credit, or you would like to take a deduction under Section 80M. Deduction under 80M is especially beneficial if you want to downstream the dividend to the individuals who are holding the shares in the Indian company. As we discussed, it's not beneficial for resident individuals to hold shares in the foreign company directly. So generally, Indian resident individuals investing in a company and then investing in a foreign company, the dividend downstream gets is beneficial under section if you claim an ATM, and a dividend gets upstream to the resident individuals. If you are not interested in downstreaming to the resident individuals, if you are okay with having the funds lying in the Indian company, you may not claim the ATM and you claim a foreign tax credit, and in which case the dividend is taxable at the rate of 25%, plus you get the benefit of the underlying tax credit. For example, if you are repatriating dividend from, let's say, Singapore, or UAE would not have any effect because in any case that is not taxable in UAE. So you will have to pay 25% tax, which is on the dividend which is received. Now, generally what we have seen, if you want to downstream the dividend to the hands of the resident individuals, the LLP is generally considered the best structure. So resident individuals investing in an LLP is investing in a foreign company, is generally considered as the most tax efficient structure when it comes to dividend getting downstream to the ultimate resident individuals. Otherwise, the tax inefficiencies would be there, and there would be a significant tax leakage when the dividend gets distributed to an Indian company and back to resident individuals. Capital reduction, one way to look at repatriation of profits from the foreign company would be capital reduction. However, capital reduction to the extent of accumulated profits, as Mr. Kapasi pointed out, would be considered as dividend, and beyond that, Section 46A would kick in, wherein capital gains would be taxed only at the rate of 12.5%. Buyback, again, buyback, whether that would be considered as a dividend when it distributed from a foreign company, considering the recent amendments which are there. And however, 222F will not be applicable to the dividend received from the foreign company, because that is that refers to Section 68 of the Companies Act 2013 and not to a buyback which is done by a foreign company. So what happens generally in a buyback? Buyback would essentially mean distribution of profits and cancellation of shares. Buyback would mean this, right? And when we talk about dividend definition under Section 222D of the income tax, it says distribution to its shareholders by a company entailing release of assets. So there has to be a release of assets, and the shares should get extinguished as a result of buyback. Now, for example, let's say in Singapore, which allows you to purchase treasury shares up to 10% of the share capital, in which case I'm not required to have a capital reduction. I'm not required to extinguish the shares which are being bought back. So in which case, probably I can argue that this would be a capital gain and not taxable as dividend. So a Singapore company would purchase the shares of itself from the Indian company, and that would be treated as a capital gain, because those shares are not getting extinguished and would continue in the books of the foreign company up to 10%, and that 10% shares which are being held by the Singapore company can be later extinguished, or capital reduction be undertaken at a later stage. There's a risk of GAR kicking in, but of course this could be explored. Another possibility of repatriation of profits is an inbound merger. Again, an inbound merger is something which is gaining traction in the last 3-4 years, wherein a foreign company which has been set up is merged with an Indian company, and that foreign company's place of business becomes a branch of the Indian company. So there's effectively the entire merger process gets completed, and the accumulated profits move to the Indian company, and basically the tax liability effectively is almost nil on the repatriation of profits. So however, this could be looked at from a GAR perspective as to why you are doing this transaction, and the GAR implications have to be evaluated when you are undertaking an inbound merger. Any questions on POEM or these aspects which we have discussed?
Vivek, request you to throw some more light on how tax residency would impact registration under Companies Act and FEMA. So that is one.
No, so from a Companies Act, there's a particular section wherein if you have a place of business in India for a foreign company, you are required to register that foreign company with the Registrar of Companies.
So under POEM, if my tax residency is defined in India,
There could be a possible risk. You have to look at the Companies Act definition of what is defined as a place of business.
so only common points will take. Ipso facto नहीं होगा.
Automatic नहीं होगा. You have to evaluate the requirements of the Companies Act, whether you require registration under the Indian Companies Act.
ठीक. Second, if POEM is decided in India and my transactions with Indian entity and that foreign entity is there, then my international transfer pricing rules
Transfer pricing
do
will not be applicable.
will not be applicable. Okay.
So
And-
that's an advantage. So even if you consider your POM as in being in India, you actually mitigate the risk of transfer pricing.
Transfer pricing. So that valuation rules goes away. One more.
Sorry? नहीं स्पेसिफाइड डोमेस्टिक तो इसमें एप्लीकेबल नहीं होगा ना
तो foreign.
वो नहीं बट उसमें स्पेसिफिक सेक्शंस लिखा हुआ है ना 48(2) भी कहाँ इन एनी केस फॉरेन कंपनीज टैक्स एट अ हायर रेट इज टैक्स एट अ हायर रेट एंड आई डोंट थिंक स्पेसिफाइड डोमेस्टिक ट्रांजैक्शन में जो 5 क्लॉजेज है वन ऑफ विच हैज बीन रिपील्ड द 4 अदर क्लॉजेज डू नॉट हैव दिस
Can I take
yes please
one more question? So let's say if I had an investment in Hong Kong and during COVID period I decided to transfer the investment and not continue with the operations in Hong Kong. So there the transfer of shares was by extinguishment, not by sale of shares. So there was no valuation and there was no repatriation of funds from
no
shares.
you need to have a valuation
You need to have a valuation, but there was no monetary exchange
So,
or no share certificate, but it
prior
was...
to 2022 write-off was only permitted subject to certain condition.
Huh.
Now after 2022 that write-off is liberalized. So you have to look at when the write-off was done and look at whether you are compliant with the provisions of the FEMA at that time.
Can I take benefit of 22 during COVID? No.
No, COVID is not an excuse for FEMA.
ठीक, fair.
Coming to, so we'll have 5 minutes more, so I'll just cover, so on the repatriation and, so I'll not cover this, basically it's liberalized remittance scheme up to USD 250, gift of foreign shares, this is something which is, most of us are not aware of, gift of foreign shares are not permitted. Unless assets are covered specifically under section 6(4) of FEMA, and even gift of shares of Indian company from a resident to a non-resident is not allowed. So this is, most of us get totally messed up with this, and we feel that since 250,000 is allowed under liberalized remittance scheme, we are allowed to gift the shares of the Indian company also to the non-resident. So this is strictly not prohibited. You need to take an RBI approval for any transaction of a value exceeding USD 50,000 or paid up capital of more than 5%. So please be very careful of when you are doing a family settlement or when you are having a structure in place to ensure that the shareholding is aligned between the family members, especially if they are non-resident family members within your family. Gift of other securities other than shares not permitted according to me, because FEMA does not specifically cover that. Gift of immovable property situated abroad is not permitted. If it's a gift of immovable property situated in India, NRIs and OCIs are allowed to receive from the resident, which should not be agricultural land, farmhouse or plantation property. So again, you need to be careful of what property you are gifting to your to your non-resident son, daughter or your brother, sister. So we need to be very careful of immovable property situated in India that should not be an agriculture land, farmhouse or plantation property. So there could be, for example, a family having a coffee plantation who wants to gift it to his non-resident daughter. Not permitted, strictly not allowed. She has to become a resident first and then only she can take the gift of the immovable property. And please remember, now the definition of PIOs has been done away with. You need to be an OCI. You need to have an OCI card to get the benefit of various gifts and the transactions which are permitted under FEMA. So you please advise your foreign citizens who are foreign passport holders who have gone abroad, if they are not holding an OCI card, please ensure that they do apply for an OCI card and they hold an OCI card. So these were the other issues which would be taken care of while migrating from India to abroad. What would happen to the overseas direct investment which is already made? I want to invest abroad, I want to move abroad. I want to invest in a house property abroad. How do I do that? So the 250,000 is the limit which is available. After moving abroad for an employment, probably I can have a limit of USD 1 million if I become a non-resident. But till the time I'm a resident, I cannot have more than USD 250,000. There are structures which are going wherein I set up a foreign company, the Indian company makes an investment up to 400% of net worth. That Indian company then starts giving loan to the person who becomes the non-resident for the purchase of house property. These structures are not permitted. Please be very mindful of that. Firstly, you are not complying with the corporate governance norms of Indian company investing in a foreign company, which is giving a loan to an individual for the purchase of a house property, which is not the business for which the foreign company was set up for. And there could be implications under income tax with respect to deemed dividend, which is missed out in this scenario because indirectly it is benefiting one of the shareholders of the Indian company which has made that remittance to the foreign company for the purchase of, for the giving of loan to that person who has become non-resident for the purchase of a property maybe in UK. So that could be a big challenge when you actually look at the transaction and draw a chart and you realize that yes, there's certain smell test is not met. So wherever the smell test is not met, please do not go ahead with a transaction under FEMA. And that is something which RBI will always look at, and authorized dealers will again report these transactions to RBI if the smell test is particularly not met. Legal provisions which are applicable, again, if you look at residential status under FEMA, it's a transaction. You look at residential status under FEMA on the date you are making a transaction. So if you have already gone abroad for the purpose of employment, you become a non-resident of FEMA from the day you are going abroad for employment. So you need to intimate to your authorized dealers that yes, I have become a non-resident of FEMA. From an income tax perspective, you look at it from a year perspective. So there could be a scenario where you are, let's say you are moving out on 1st January 2024 and you therefore become a non-resident under FEMA from 1st January 24 to 31st March 2024, but you are still a resident under Income Tax Act from 1st April 2023 to 31st March 2024 because you have resided for more than 182 days in the entire previous year. So again, moving abroad employment is just not the in thing, you have to look at substance. You need to have employment in substance. You just not create a company and just show journal entries for the purpose of drawing salary. Please do not do that. That's a huge red flag. And you need to have foreign laws which are there with respect to labor and social security in place. Salary should be commensurate with the position. You just not show salary for the sake of showing salary. If you are a person who was already a managing director of an Indian company which was doing well and you're shifting abroad for the purpose of employment, you do not keep drawing the remuneration in India and you also start drawing remuneration abroad, which is a very meager sum just for the sake of compliance under foreign exchange laws to say that I've become a non-resident under FEMA. So these are aspects which you need to look at. Work permits are often missed out. I go on a tourist visa and then I show that I've become employed in a foreign company. So those are aspects which need to be looked at, and right documentation should be in place, the right contract should be in place. Again, I think I will not be able to cover the rest of the slides. So, any questions I'm happy to take. In any case, I'm always in Calcutta, so I can always have another session on these aspects. Thank you.
If anyone has any questions. So I'll just ask one short question. Like you said that there cannot be any gift of shares of an Indian company. So in an example where like there's a promoter and whose only child is in abroad and unfortunately he passes away. In this case,
Inheritance is allowed.
Inheritance is allowed. Okay.
So inheritance is permitted under section 6(4) of FEMA.
Okay.
That's a general provision which is there.
Okay. Okay. There's one question in the back.
Sorry, I had to move slightly fast. मतलब ठीक है मतलब.
Not slides.
Actually, because of the time crunch.
We request ACA to have one more session.
Yes, you will definitely.
I think we already discussed on it, but I just want to re-ask. जो phantom shares का एक concept है जहाँ पे shares are held in foreign entities by a trust registered there and the beneficiaries are Indian employees of the parent company का shares है, Indian subsidiary का employees are getting those shares.
ESOP का बात कर रहे थे, वो हम ESOP का एक बार हमको लॉ पढ़ना पड़ेगा वापस. मतलब कंचन दा इज ऑल्सो, if you are aware you can clarify. The safe.
Share appreciation rights, yes, yes.
So एक बार उसको चेक कर लेंगे. स्टॉक अप्रिसिएशन राइट, अगेन फेमा में देयर इज नो स्पेसिफिक प्रोविजन अंडर फेमा टू अलाउ फॉर दैट. It's a capital asset. It's a capital account transaction. So probably if it's not specifically allowed, I would probably say it's not permitted.
Okay.
Unless it is a employee stock option or a sweat equity.
Because there are a lot of transactions, similar transactions happening where the employees of Indian companies, which is a subsidiary of a foreign company. So suppose even large corporate SAPs is also doing.
No, there is a difference between they are entitled to a share in that company which is equivalent to that share. So
Yes.
ultimately, वो आपका अगर stock appreciation rights gets converted into share, then it is okay.
Okay, because the beneficiary is never, the registered name is never of the employee, it's always of a trust.
Trust is not recognized as a person under FEMA. If I am considered as a direct beneficiary entitled to so much of shares through that trust, then it is okay. So if I am having an equity stake in that company indirectly through that trust, in which case it would be permitted.
Okay, and if that company happens to be unlisted, then
There could be a challenge. But again, in the exceptions to the Schedule 5 of the resident individual investment, employee stock option plan below 10% without control is permitted.
Okay.
So that is an exception which is there.
Okay.
So that exception we can probably read out offline, so we can discuss that.
Okay, thank you.
I think we'll wrap this session up right now. I'll request CA Rashmi Chaucharia to kindly give a formal vote of thanks.
Thank you everyone. I, Rashmi Chaucharia, on behalf of ACA and EIRC, would like to thank the speaker, Mr. Vivek Nevatia, for his wonderful insight and deliberation on topic tax and FEMA implications for immigrating and immigrating individuals. Vivek, you have done wonderfully the session. Your insights were very nice, and I think we need a session. I'll ask Tarun Bhaiya to please organize a session so that all the questions are answered and he's able to complete his all the slides. I would also like to thank Ayush for wonderfully moderating the session, and last but not least, the wonderful patient participants. Please join us for the lunch, and we will start the next session at 2:15. Short time for lunch. Thank you.
Thank you so much.